Hello everyone, welcome to Channel. Today with a book. The original title of the book in English is The Great Debt Crisis. You may have heard about the global economic crisis. Even the United States, which is an economic powerhouse, has experienced economic crises frequently. In fact, it happened in 2008, 2001, and 1987, etc. And most of it was caused by debt. The word debt can relate to individuals and individuals, companies and companies, and can be as large as countries and countries. What is debt? Money that you owe someone and must repay them, both principal and interest, is called debt. Debt can be bought, sold, traded, or discounted. You can borrow money from friends without paying interest, but in most economic sectors, interest must be paid. In our mindset, debt is not a good thing. However, the author understands that borrowing money is like borrowing time. You are simply borrowing money that you can earn in the future to use in the present, which makes the economic situation stronger. If you are afraid to pay interest and do not borrow money to use, you will lose the opportunity to grow. And this opportunity to grow is worth more than the small interest you have to pay.
For example, two cities have similar populations, similar economic conditions, and both want to develop the same road. City A refuses to borrow money, preferring to save its income from taxes and royalties little by little until it starts construction. Suppose the price of materials does not increase. Then it will take 10 years to save all the money, so it will lose money for 10 years. City B borrows money from the bank to build the road. The land along the road has increased in price. People can travel more easily, attracting more investment to the city. It can still collect taxes normally and earn income from the road and other investments. Earn money gradually, develop gradually, pay back the bank gradually, make more money, and save time for years. Which city do you think will develop more?
This does not mean that all loans or debts are good, because you have to pay them back. It is this debt that can create risks and crises. What do you rely on to make you dare to borrow money? As for the bank, what do they rely on to make you dare to lend money? They look at the cash flow you can have in the future, which includes both the regular income you have today, such as salary or business income, and income from the project you borrowed money to develop. However, if you borrow too much, the debt increases too quickly and your income is less than the debt, causing you to not have enough cash flow. You will have a cash flow problem or even an economic crisis. Even if you have done a thorough analysis using data that has occurred in the past to predict future sources of income, some problems have arisen that you could not have predicted.
For example, you have an income of $500 per month, while your life partner sells food at a school, earns about $300 per month. You want to expand your business by expanding the size of the store to accommodate more students. You thought that you had one source of income and that you could earn more money after construction. If the situation is as good as you think, it's okay. You will have enough money to pay off your debts. Unfortunately, who knows about the COVID-19 outbreak, and students are not going to school, but instead are learning online. You can't even imagine that there will be a lockdown that will prevent you from going to work. Your two sources of income have gradually dried up. You can't predict when the COVID-19 pandemic will end. If you borrow more money from the bank, you will have a bigger burden, a higher interest rate, until you no longer have the money to pay off the debt and create an economic crisis. Nicholas Taleb has named any event that is difficult to predict a major event that, when it happens, changes many contexts, such as the terrorist attacks on the World Trade Center on September 11, including the tsunami, as a black swan event. He also tells how to profit from such events through the book Black Swan. It is the same for a country's economy. The author argues that an economic crisis caused by debt is inevitable. When the economy reaches its maximum point, it will start to fall back down, fall to a certain minimum point, and then start to rise again. In the past and in the future, it will continue to follow this path. Economic crises will occur every 10 years. The book Black Swan states that because of the current technological advancement, it is impossible to predict when a black swan will occur.
Although we cannot prevent it from happening, both authors understand that we can take advantage of these events or draw benefits from them. In this book, the focus is on the economy of a country. If you are interested in drawing benefits for individuals, you can try listening to the book Black Swan. The author divides economic crises caused by debt into two types, one caused by inflationary currencies and the second caused by deflationary currencies. In simple terms, it means that goods increase in price and money decreases in price, or goods decrease in price and money increases in price.
For example, in the past, a bowl of noodles cost 4,000 reals, but now they sell a bowl for 6,000 to 8,000 reals. 4,000 reals can no longer buy a bowl of noodles. At this time, they say that money has become cheap. The technical term is inflation. If the price of money increases, a bowl of noodles will be cheaper than 4,000 real, which is called deflation. 4,000 real remains 4,000, but the value of money that can be converted into goods changes. Let's look at the economic crisis that occurred in the United States. In 2001, due to a terrorist attack on a commercial building, the economy fell sharply. We can take that as the first stage. The economy began to grow again, from individuals to companies and even the United States as a whole, and debt began to increase. This stage was a golden stage, a healthy growth. Income grew faster than debt. When it reached its peak, debt growth was faster than income, and it began to enter the bubble stage. In this stage, the economy continued to grow, but in reality, it grew only because of debt.
From 2004 to 2006, the U.S. economy continued to grow between 3% and 4%. Inflation was not high. People lost fewer jobs than average in the past. The stock market also gained 35%. At this time, many people continued to borrow money from banks and invested that money in the financial sector. The financial sector also continued to lend. This is repeated many times, causing the debt to grow larger. The value of real estate also increases, and when giving loans, real estate is used as collateral. It is estimated that the value of real estate will increase steadily. The conditions for providing loans for the purchase of real estate are also becoming more relaxed. Even those who have no income and no means of repaying the debt can get loans. This has made lending less secure, more risky, and less creditworthy. The influx of money into the real estate sector has caused property prices to rise, attracting more people to invest in real estate, even if they have no money on hand and are willing to take out bank loans. In 3 years, property prices have increased by 30%, and compared to 2000, it has increased by 80%. In 2006, household debt reached 120% of total household income. In 2007, the bubble economy reached its peak. People still think that the market can be better, but unfortunately, it cannot be better. Currently, the cash flow generated by the economy cannot pay off all the debts, nor can it borrow more to pay off old debts. When the bubble reaches its maximum, it will burst, and the market will also be the same. When it reaches its peak, it will fall back.
Many people are unable to pay their debts. It is one thing to stop paying their debts. Another thing is that those who have money no longer trust the banks, run to withdraw their savings from the banks, afraid that the banks will fail. When people come to withdraw their money, there is no money to withdraw because the money is tied up in real estate. People will start to panic and withdraw more money, and finally, there will be a series of bank failures. The real estate debt at that time was about $5 billion. Such a huge debt had a huge impact and pulled the financial sector into a recession. In 2008, the stock market fell by 40%. The unemployment rate exceeded 10%. At this stage, it is called the recession stage. Then came the recession stage, when the bubble burst until the air ran out before the economy could start to return to normal. At that time, the U.S. government tried to protect major financial institutions by lowering interest rates, producing a lot of currency in various forms, and turning the economy around. The debt structure began to shrink and return to normal in 2012. At this point, we can conclude that the economic crisis cycle could last about 12 years.
We come to the main point that we need to discuss today. The following is just an analysis based on the theory that the book mentions. We can see the shadow of America's past on Cambodian soil. Land and real estate prices in Cambodia have increased significantly since 2012. It coincided with the recovery of the U.S. economy, which can be considered a golden period. Many banks have encouraged real estate loans with easier loan terms, lower interest rates than regular loans, or using the purchased property as collateral, etc. More and more people are willing to borrow money from banks to invest in real estate. We have observed that in recent years, real estate prices have continued to rise steadily. Let's assume that it is a bubble phase. We can see that in 2020 and 2021, due to restrictions on online gambling and the impact of COVID-19, the real estate sector is not as dynamic as before. No one knows for sure whether it is the same bubble phase or the peak phase. If it is in the bubble phase, after COVID-19 has subsided, prices will continue to rise. If it has reached a peak, prices will start to fall again. Which phase do you think it is in?
A study showed that after the financial crisis in the United States, the rich got richer, the middle class got poorer, the poor remained poorer, and the gap between the rich and the poor widened. In China, the same phenomenon occurred. This is according to Chen Ji-woo, director of the Institute of World Asian Economic Research at the University of Hong Kong, who spoke at the Economic and Financial Summit held in Beijing on December 5, 2020. In fact, when the economic crisis occurred, the rich also suffered the same crisis, but they saw it as an opportunity. At this time, stocks and real estate are cheap. If you buy now and sell later, you will make a profit. The rich expect that after the rain, the sky will clear up. They believe in their eyes. They are willing to endure the hardships now, as long as the crisis is over and the situation will be better. Because the government tried to pump a lot of money into the market to help revive the economy, causing high inflation, the assets owned by the middle class have fallen in value, which has made them poorer. The middle class may tend to follow the wind and see what others do. For the poor, because they are already at the bottom, they have no inclination to invest. Even if they want to borrow money from banks, the banks will not approve them. Even if they see opportunities, they cannot do anything. In addition, even if they fall even further, they are still at the bottom. According to the book Black Swan, it is said that you need to divide your assets and resources into two parts. The large part, about 80%, should be put in places with low risk, such as buying government bonds, etc. This money is very safe and can be withdrawn at any time. The other small part, about 20%, should be put in places with high risk but also high opportunities, such as investing in tech startups and investing in the security sector. Because when a black swan event occurs, some companies will have problems with their stock prices falling. They sell them, we buy them back, and after the situation improves, we will make a profit of 10 times, 100 times, which can be used to offset our losses in other sectors. However, we must clearly analyze which company to buy and when to buy. Now, let's review a little of what we learned from the book Debt today. Debt is not a bad thing. The important thing is what we borrow money for. Borrowing money is like borrowing time. You are simply borrowing money that you can earn in the future to use now, making the economic situation stronger. If you are afraid of paying interest and do not borrow money to use, you will lose the opportunity to grow, and this opportunity to grow is worth more than the small amount of interest you have to pay. Here, they encourage you to borrow money to invest and have a clear plan, not to spend money to splurge and annoy others. Many people dare to borrow money, and banks dare to approve loans because they see the cash flow that may occur in the future based on the current situation. No matter how carefully you think, there are still times when you can still fail due to some unpredictable factors. When the cash flow is not enough to pay off the debt, it is easy to have an economic crisis.
Crises caused by a country's debt can occur due to inflation and deflation. It is divided into 6 stages: the first, or golden stage, the bubble stage, the peak stage, the recession stage, the decline stage, and the normal stage. That is 3 stages of growth and 3 stages of decline. The entire cycle of stages lasts more than 10 years. A study has shown that after the economic crisis is over, the rich get richer, the middle class becomes poorer, and the poor remain poor. Economic crises can be an opportunity for growth if you know how to use them. You can buy when they are selling and sell at a profit when the situation is better. But please analyze carefully before buying, when to buy and when to sell, and be clear in your mind that you have enough capital to wait until the economic crisis is over and the situation is better. Congratulations on finishing another book. Thank you for listening to all of you.